this assignment is very important for a number of reasons. One of them is that what you have to do here, you have to do something which is a little bit complicated the first time you do it, okay? But once you do it, you're going to learn something very important doing this assignment. And this is why I want to make sure that everybody understands. So I need you to do the calculation of, or the construction. I wanted you to do the construction of a risk parity portfolio. You're going to have 3 possible investments: the S&P, the Hang Seng Index, and the hedge fund index, the HFR index. And you need to construct a portfolio that has the same risk contributions for each of those 3 indices. So, and you have to do that assuming 0 correlation between the indices and then using the real correlation between the indices. The first part, this is easy. The second part is hard. First part is easy, the second part is hard. And I want you to understand how this is done. And the key to this, there's several things that you need to keep in mind. So again, I would like to ask, has anybody started to do the assignment already? Have you started to work on this? It's better if you have, because then you'll understand better what I'm going to say. If you have not, then some of these things may not be very clear until you start. So, has anybody started? Yes or no? Feel free to say yes or no. I just want to know. On the chat, you can put yes, no. Nothing? No answers? Yes, clear, yes, yes. Okay, good. So the key, the first part is key to do that with 0 correlation. And for that, we already went through the formula, how to do that. Okay, so this is what these are the notes. This is an important slide. We saw that if the assets are uncorrelated, then the sigma ij are 0. There are no in the expression for the portfolio volatility, there are no cross terms. The portfolio volatility is that when they are uncorrelated, and in that case, when they are uncorrelated, the partial derivative of the volatility with respect to the weights of the allocation to each index is given by this. So if we want all of these to be the same, we saw this last week, we want all of these to be the same for different i's and j's, we need this thing to be true. So this thing cancels, and what we need is that the wij sigma squared has to be equal to wj sigma j squared. Okay? And these have to be equal to, they have to add up to the money we have. So if we have $1 million, this should add to $1 million. And the result of this was that the amount of money we're going to invest is inversely proportional to the volatility of that investment. So in the case of no correlation, the solution is very simple, and we have it here, not in the case of those indices, in the case of other indices. So you just need to calculate the standard deviation of your 3 indices, and then 1 over the standard deviation will give you the weights, as you can see here. Okay, so this part is easy. You just have to get your data and calculate the standard deviation. So when I ask you to do this, you're going to calculate the standard deviation of the S&P, the standard deviation of the Hang Seng, and the standard deviation of the hedge fund index. That will be 1, 2, 3. Okay. and then you have to, this gives you the proportions. So the allocation to the S&P 500 will be, you have $1 million, okay? Let's say, or here I'm assuming, yes, $1 million. Then you have to divide that by the volatility of the S&P, which is sigma 1, okay? But then the sum of all the allocations has to equal $1 million. That means that you have to do one more thing. You have to divide by the sum of 1 over sigma I between 1 and 3. So you have to add the inverses so that the total allocation that you have, sorry, no, this is not right. It's not right. This is, you have to multiply by the sum of 1 over sigma 1 over sigma 2 and 1 over sigma 3. You have to divide by that, okay? That's what you and then this will do it. This has a contribution, an investment in the S&P 500, which is inversely proportional to the volatility. And when you add up all of the allocations, this would be the W1, the allocation to the S&P 500. And when you add up all of them, you end up with $1 million. So this is the right way of dividing the $1 million into the 3 indices that we have here. You just need to calculate the volatility of each of them. And for the volatility, you have the data set. So this is something that can be done. You can do this in Excel. You can do this in Excel. Okay. Is this clear? This is clear. Yeah, good. Okay, so you know how to do that. Good. The question is then, so you're going to do that, and this is good. I want you to do this. But now, what if we want to do the allocation, the risk contribution with the correct correlation between the indices? In other words, we no longer assume the correlation is 0. What if we do this with the correlation which is the real correlation between the indices? How do we do this? When we go to the calculation that we did here, we see something breaks down. It's right here. So this thing breaks down because what happens is if the correlation is no longer 0, then the portfolio volatility, what is it? It's the square root of this. This, and then inside it, I need more room here. The portfolio volatility is not that, it's something bigger. It's the sum of the allocations squared between 1 and 3, we have 3, and then we have the cross terms. The cross terms are like this. You have to multiply the weights on each of the investments times the covariance between those investments. So the covariance you can find. You're going to find the covariance matrix. That already tells it. You need to have not only the standard deviation, the volatility for each investment, but you need to have the covariance, the IJ. Okay, and you do this in Excel, for example. So this is known. This you get from the database. You get that from data. So you have this information. All this information here is something that we have. Now, from this expression, so I'm going to delete that. We already know that. So from this expression, what you have to do now is you have to, from here, you have to calculate this. You have to do this yourselves. How do you do that? Well, when you do that, you have to, for example, with respect to 1, let's do the S&P. The S&P 500 is number 1. How do you do that? Well, you have to divide, this is the square root. The derivative of the square root is 1/2 over, so that's going to be 2. And then the square root is sig downstairs. And then what you have here is 2 times W1, sigma 1. Okay. And then what you have here is the sum for all the j's which are not 1 of W sigma I1. Okay? You do this differentiation yourself. And you do this for the 3 indices. And this gives you an expression. Let's say that you go with your allocation, the one that you obtained, when the correlation is 0. Okay? So you would take the annual. So if you do this with the answers that you obtain when the correlation is 0, you will see that you don't get an identity. You don't get an equality. Okay? You're going to... And this is key to understand this, okay? If you take a collection of weights, which is not the right one, for example, the one that you have from the 0 correlation assumption, then what you will find is that when you do this multiplication, and very important, this is a calculated value. When you do this multiplication, you don't get, this is supposed to be sigma divided by the number of indices. This is supposed to be sigma over n, because they're all the same, right? You're going to see that you do not get that. You do not get that. Then what do you do? And this is the important thing. This is what you have to, this is the highlight of today. You have to pay attention to this. What happens when you don't obtain what you need? If this was true, then you would have found the answer, but this will typically not be the case. Okay, what do? What you do is you change the weights. You change the weights so that the weight becomes sigma divided by n times the derivative you just found. Okay, that's what you do. Now there's something very subtle and important that's going on in here. This is not the solution. This is not the solution. The fact that you said W equal to this is not the solution. Why? Because this is a calculated value with a different set of weights. In other words, what you have here and what you have here and here are different. They are different functions of the weights. Okay? So you're not finished. You're just constructing a new iteration. So what we're going to be doing is, this is what you have to do. This is the part which is, you have to do this yourself. There's no other way to understand this. Okay? And I'm happy to start with this discussion every day until you do it. So you're going to have a set of weights which is coming from 0 correlation. Okay, it works when the correlation is 0. But then when you introduce the real correlations, you will see that the real correlations make our identity not hold. So using the method that I just described, you're going to have a new, this is 2 and 3, a new set of weights. Okay? And then you're going to apply the same inequality you just found, the same derivative, and you're going to see that still doesn't work. And then you find another one, and then another one, and you see this still doesn't work, and you have to construct a sequence. And this sequence will converge to some weights. And these are the weights that will work. Okay, so this is something which is called an iterative process. And it's based on the mathematical notion of a fixed point. Okay, can you answer in the chat if you know what a fixed point is? Have you seen that in mathematics? A fixed point. I don't know how you call that in Chinese. I'm sorry, but have you come up with a fixed point is a point that makes this identity true. This is a fixed point. Have you seen that? Answer in the chat, please. Yes or no? Fixed points have very interesting properties, and we just found our first fixed point in this course. It took us 2 months, but we found it. The world is full of fixed points. Can you please in the chat say yes or no? If you have seen this, say yes. If you have not seen it, say no. I just need to know. So, yes, no, yes, 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 no. Okay, it's a combination. Okay. So then allow me to spend some time on this, because this is very important. This is, strictly speaking, not quantitative investing, but this is mathematics. But it's mathematics that happens very often, and it happens here too. Okay, so allow me to then explain something that you have seen, I'm sure, but I'm going to explain in a different way. Let me use an analogy. I want you to compare this part of the assignment, which is difficult, with another thing that you have seen before. So for that, I have to share something. I need to share my content. I need to share. I'm going to start sharing my whiteboard. Let me talk about a different problem. How do you find the? You have a function like this, and you have to find that point. How do you find? This is function f of x. And the question is, how do you find f of x equals 0? These are the zeros, so the roots of this function. How do you find these? There are many methods. Okay, the one that I'm interested in, the one which is most interesting for us today, in Canada, we call it the Newton method. The Newton method. It was done by Newton in the year 1700s. Okay. And the way it works is as follows. You have seen this, I am sure, okay? But let me show you how this method works. This method works as follows. You start with a point, any point. You don't know what that point is. You're trying to find it. So you pick one point, this one, okay? And then you call it x1. And then you evaluate f of x1. F of x1, you will see that f of x1 is not 0. Because, okay, if it was 0, then you're finished. You already found what you're looking for. But typically, you will see that it's not 0. So what do you do? What you do is this. This is how the method works. You draw the tangent to your curve, okay? And the tangent to the curve, we know what it is. You can find the tangent using the derivative. Always the derivative, okay? You find the tangent, and then you find where the tangent line crosses the axis. The advantage of that is that you know what this is. You know what this is, because the tangent line here has an expression is y minus f of x1 equals the derivative at x1 times x minus x1. That's the equation of the tangent line. This is the equation of my tangent line right there. So I can solve for this tangent line, and I can find what we call x2. And I want to put x2 in a different color. And I want to put x2 and blue. So x2 is the zero of the tangent line, is what I obtain when I make this tangent line equal to 0. And I know that then x2 is going to be x1 minus f of x1 divided by f derivative of x1. Okay? I'm sure you have seen this before. Please write in the chat again. I want to make sure that everybody understands this. I'm explaining something very important today. So can you write in the chat if you have seen this before? Yes or no? In the chat. Yes. Yes. Okay. Okay. Everybody has seen this. Good. Okay, very good. So you have seen this. And you know how this continues, right? Now you take x2 and you do the same thing. You evaluate x2, it has a value there, and this is not 0. It will typically be closer to 0, not always, but it's not 0. But what you do is the same thing. You find the tangent to that line, and then you find another point, and this point will now be x3. And x3 is x2 minus f of x2 divided by the derivative of x2. And so on and so forth. And what this does is this gives us a sequence x1, x2, x3 that converges to one point x infinity, and that's the solution that we're looking for. That's the solution. That will solve the equation we're looking for. Okay? So you are finding a solution to an equation through an iteration process by constructing a sequence. And this sequence happens to be also a fixed point. It's a fixed point of what function? It's a fixed point of this function, and I'll write it in maybe in green. It's a fixed point of this function. X equals x minus fx divided by f prime x. Okay? In other words, if I call this function here capital F of x, this is my fixed point. I'm looking for a point where x is equal to capital F of x. It's a fixed point. You see? And a fixed point is usually always found by iterating. You start with one value, it's not the right one, but you find capital F of that value, okay? And then it's not that one, but then you put that value back into F, and then you try again and again and again and again until it converges. That's how this method by Newton works. So there's two things. One, you can understand this method from this perspective that we saw here. You can understand this method from this perspective. Just see here. Yeah. You can see this method from this perspective, or you can see this method from that iteration perspective. Okay? It's a fixed point, and you find the fixed point by iterating. Okay, so this is how we do this in this particular case. And you have seen this. So when we go back to the construction of a risk parity portfolio, note that we're doing the same thing as the Newton method. Okay? Note that we're doing the same thing as the Newton method, because now what we have is we need to find these equations that we need to solve. These equations that we need to solve, all of these equations, the equation that we need to solve here, they can be written, I'll rewrite them today as this. Wi times this I had to be equal to sigma divided by n. These are the equations that we have to find. So these equations, we're going to be rewriting them conveniently as the vector W, the weights, all three weights, the vector W has to be equal to a certain function f of the vector W. And what's that function f? That function f that we have here is sigma divided by n times the derivative of sigma with respect to sigma I. That's my function f. See? It's exactly the same method as the Newton method. And for that, the way we're going to do that is we're going to construct a sequence of weights. We'll start with the first sequence of weights. We call it W1, and then W2, and then they're all vectors, okay? They're all vectors. Then W3, then W4, until it converges. And you will see that it converges quickly, converges very quickly. Okay? And the interesting part is that the first vector here, this is this uncorrelated. That's going to be your guess. That vector is already close, but you'll make it exact as you construct this sequence. And this sequence you obtain by iteration. You have to calculate the derivative. Okay? So I already told you that this is an assignment which I want you to do it on your own. I want you to do it, because you will see that once you finish, it's not very difficult, but you have to organize your ideas very well. Okay, and that's why I want to. I want you to try. So I don't know. I want to get some feedback from you. I don't know the level of difficulty that you find with this. I don't know, but I would like to know. I don't know how much more detail I should give you. I don't mind spending any amount of time on this. This is very important, okay? This is one of the most complicated things we have seen so far. And that's why I want to make sure that everybody understands this. So maybe I can ask in the chat if you can put, it's clear, it's not clear, you already knew it, it's easy, I'm not sure. Give me some feedback, I want to understand. And I don't want to bore you with things that you already know. Okay? But if you've never seen something like this, then I'm happy to give more details. So write in the chat, just give me an idea of the level of difficulty this has for you. You have to calculate one derivative. That's it. That's okay, and then iterate. But you have to find what is the right formula to iterate. So yeah, please write something on the chat. I need to know. This thing that we're learning now is very advanced. It's one of the most advanced things we will see in the course. And if you're able to do this, this puts you in a very good position, in a very competitive position, because not many people know how to do this. So if there is no answers in the chat, I'm going to assume that this is because this is not clear, okay? So I'm going to assume that you do not understand this, which is no problem. I want you to understand it. So what I'm going to do is this. This is what I'm going to do. This is what I'm going to do. So I want to assume that this is not clear. What I'm going to do is, in assignment number 8, don't do that for now, okay? I will create some special notes for you that is going to be a combination of mathematics, numerical methods, and an application, how you construct risk parity when the correlation is not zero. So if this is not, I'm assuming this is not clear. That's how I interpret your silence in the chat. So if this is not clear, although you have seen the Newton method, I'm going to assume that this is not something you know. So I will devote some time next week to explaining this to you in more detail so that it is clear. Okay? Is that okay? Yes or no? You have to say something. Yes, it's clear. Okay. Is this good? You like this? Yeah? Okay. All right. So then don't do that. Don't do that part. It seems to me that you didn't understand what I told you. So I'll create some maybe 4 or 5 slides specifically about this, an application. There will be a combination of mathematics and computational methods. Okay, and this you can do in Excel. You don't have to do this. You don't have to know some, C or Python or something. You can do this in Excel. I'll show you also. Okay. And the reason is we're only doing this with 3 investments. If you have many more investments, then you may need to be more sophisticated. But with 3, you can do it in a simpler way. Okay, so don't do that. Okay, don't do that. Okay, I will say not yet. I will say not yet. You will do it. This is very important, but I would say not yet. Not yet. Okay, later, next week. Okay. Okay. So this is, I'm going to leave assignment 8 now. I want to stop assignment 8. I'm going to go back to the lecture. Any questions about this? I guess it's just you just have to do that. You just have to do the first part. Only that for now. Okay? Okay, no questions. All right. So, so in that case, I'm going to get rid of this. I don't need that assignment anymore. I'll redo it. I'll say one thing. Okay, when you do this, this is something very sophisticated you would have learned. So I want you to be proud of that. Proud of yourselves. Okay, you would have done something very, very good. Okay. So this is where we ended. I showed you this example, which you will have to now do with the S&P 500 Hang Seng Index and with the hedge fund index. But you do that on your own. Today, I'm going to now talk about something different. We now know how to construct portfolios. We've learned that. Okay, we can construct portfolios. We saw a few weeks ago how to construct portfolios with the Markovitch theory, with the optimal Sharpe ratio, and now we saw 3 methods: 1/n, risk parity, and minimal risk contribution. So 5 ways of constructing portfolios, which are the 5 methods which are used in practice in industry. Okay, 5 methods. So we are very good at constructing portfolios. And when you finish assignment number 8 or assignment number 9, you will see that you're very good at constructing portfolios. So now what? Well, you can construct portfolios. That's great. And you can construct portfolios of now many different types. You can construct an index portfolio. This is your assignment number 8. This is assignment number 8. Okay, this is an index portfolio. You can construct a hedge fund portfolio. You can construct an equities portfolio. It's the same method. It's just that now instead of having only 3 indices, for example, you have many, many more. Because you have stocks, you have bonds, you have hedge funds, you have infrastructure projects. So many more numbers, and then computation gets more difficult, but the concept is the same. Okay? I'm not going to talk about that. So we're able to do this. We can construct very good portfolios. And what I want to discuss now is when we can construct very good portfolios, very often, the portfolios that you construct employ leverage. And I want to explain to you today what that is. Now, before I do this, I have a picture that I'm going to explain here. But before I say that, let's go back to the snow fund. I already told you the snow fund was going to be a good example for us to use. In the snow fund, we were able to construct a portfolio of swaps if we have $2 billion. Okay? With $2 billion, we could construct a portfolio of 100 swaps. And we said that we needed 2 billion. What would happen if instead of 2 billion, I only have 1? So snow swap, or a snow fund, a snow swap fund. What if I only have 1 billion? Well, I'm short. You can say, well, then let's only do, instead of 100 swap portfolios, let's do 50. We could do that. So option number one, if I only have this amount of money, option number one is to do only 50 swaps. But option number two is to borrow 1 billion from a bank. We have that option. We can go to the bank and borrow 1 billion from the bank. We already saw that there's a chance that we could do a deal with less money if we convince the city or the ski resort to allow us to do the swap deal with less money than the full payment. But sometimes that's not going to work. But we could go to the bank and say, I have 1 billion here, and then I have this opportunity of doing a $2 billion investment, but I am short $1 billion. Guess what? Sometimes the bank will say yes. The bank sometimes will say yes. And this is what we need to understand. Now, this is very interesting because now we can do investments when we have less money than what we would like. That's one way of looking at it. Okay? Another way of looking at it is we can do an investment that may have some very good performance, but we use money which doesn't belong to us. We use money that belongs to someone else, not even the investors. Okay? And this is what leveraged products are about. We're going to use someone else's money. Okay? And think of that. In fact, if you have ever done investing, this is how you would like to think about this. Let's say you're going to do investing, but you don't have enough money. You would like to invest more. Then you go and you borrow money. You borrow money from a bank, you borrow money from a friend, you borrow money. That's what we're going to do. When we do that, we will see there's many different ways of borrowing money. Borrowing will suddenly become a philosophical term. Many ways of borrowing money, and sometimes we want to do it, sometimes we don't want to do it. Sometimes they may lend us money, sometimes they may not lend us money. So we're going to understand how we can borrow money to do investments and whether that's a good thing. Okay, so when you do that, some notation. The money you have is called equity. Okay, so think of yourselves. Let's say that you want to buy a portfolio of 1,000. Let's make it a little bit more interesting. 100,000 RMB. Okay, but you don't have 100,000 RMB. You have say 25,000 RMB. Then you go to the bank and say, can I borrow 75,000 RMB so I can invest? So your 25,000 is the equity. And you're going to borrow, in this example, 75,000. That will be called debt. And now you have 100,000, which you invest. You invest that in a 100,000 is not enough for a hedge fund, so you can do that in a stock portfolio. For example, that would be the situation. Okay? You have 25,000, you're going to borrow 75,000, So you can invest in 100,000. Do you like this? Is this a good thing? How much does it cost before you do a structure? This is an investment structure. Okay, the 100,000 goes into the investment structure, and that's 25,000 of yours and 75,000 of the bank. Today we're going to borrow money mostly from a bank, and it goes into a structure, and the structure goes into the investment. Is that a good thing to do or not? It depends. What return do we get from the investment, and what interest rate we have to pay for the debt? These are the two things that we need to know. So let's do a very quick calculation. Very quick calculation. What is the percentage of borrowing? To make things easy, let's say it's 0%. Okay. And what's the percentage performance? To make it easy, like in the snow fund, we say it's 10%. So if this is what you get, this is what you have, that 10% at 0% borrowing, of course you want to do this. You want to borrow as much as you can. Because if you look at the previous example, you have 25,000 of yours, and you borrow 75,000. The 100,000 that you have here is going to give you 10,000. Of the 10,000, let's say that you borrow for free. 10,000 when is 10% return, but 10,000 if you invest only 25,000 is 40% return. The return gets multiplied by 4. Why? Because you only put 25% of the whole structure. So sometimes this is a very good deal. You may be thinking, I want to put this in a different color. What if my borrowing is not 0%? What if my borrowing is, say, 5%? If my borrowing is 5%, my performance is typically goes up with the borrowing. So that's maybe 15%. Then the amount of money I make here is not 10,000, it's 15,000. But I have to pay for the borrowing. I have to pay 5% of $75,000. I have to pay 5% of $75,000. So 5% of $75,000 is how much? This is my cost. So I have to multiply 5 times 75,000. So I have 30. So I have $3,250 that will have to be deducted from that. So I make approximately $12,000. Okay? My rate of return is actually just as good because I only invest 25. Okay? So the advantage of investing like this is that if the borrowing rate is less than the performance, this investment structure is always good. Okay? And that's why these investment structures exist. Okay, but let me go into how these things actually happen. And I have 4 examples for you. I'm going to use the same numbers that I used before, 25, 75, and 100, except now they're going to be million, not thousands, millions. Okay? There's 4 ways of doing that. So you're going to invest 25. Could be $25 million or 25,000 RMB. It doesn't matter to us. Okay? All right. So the first way to do that is what we described earlier. 25,000 or 25 million is what you have, but you're going to borrow 75,000 or 75 million to invest 100. That's one way of doing that, okay? And this is taking a loan. Understand? That's one way of doing that, but there's another way of doing that. It sounds the same, but I'll explain the differences in a minute. The difference is you go to a bank, the bank doesn't give you the money, you give the money to the bank. You give the bank 25,000 that the bank will then invest with their own money 100,000 into an investment for you. What's the difference between 1 and 2? Who can tell me the difference between 1 and 2? I know that you don't talk very much, but I still want to ask. What's the difference between 1 and 2? Anybody wants to say? The difference between 1 and 2 is that in investment 1, the bank gives me the money. In investment 2, I give the money to the bank. To you, it doesn't matter. You don't care, because in the end, you're going to have the same investment. In one case, you do the investment, in the other, different risk. So this is, thank you for answering, Ying. Thank you for answering. The difference between 1 and 2 is, for you is the same, but it's a different risk for the bank. Why? Because in the second case, the bank has the investment, the 100 million or 100,000, the bank has it, okay? In the first one, the bank doesn't have anything. So if you happen to run away with the money or something, they'll have to go after you, and that's difficult. In the second one, they don't. So this is a type of risk which is under, we already saw this. This is a different, we saw this as credit risk. In the first case, the bank has credit risk to you. In the second one, the bank has no credit risk. The market risk is the same. If the investment does badly, then you and the bank will have exactly the same exposure. Your risk is the same. But from a credit risk perspective, part 2 is better for the bank. For you, you don't care. It's the same. Okay? I'm assuming that the bank is big and you're small. Sometimes it will be the opposite. You know, the investor is big and the bank is not so big. In which case, it's different, right? So typically, the credit risk comes from the big investor to the small investor. So this is, and this is interesting, because the same investment with the same market risk profile could have a different credit risk profile. But we already learned that credit risk profile is very important. We saw that in the snow fund. Okay. Now let me go to the third way of doing this. The third way of doing this is an investor gives the 25 to the bank, and the bank doesn't do an investment necessarily. What the bank does is the bank promises to give you the return, the performance of $100 million investment. Okay? What's the difference between 2 and 3? Who can explain that to me? To you, there's no difference. It's the same. You don't care. And let's say that you invest in the Hang Seng Index. It's very simple. Okay, you want to invest $100,000 in the Hang Seng Index. You only have 25,000. You go to the bank and say, "Here's 25,000." Okay. In the second part, you say, "Here's 25,000. You take it. You put 75 of yours and you invest it, and the return is for me, and I'll pay you interest." That's what you would do under part 2. Under part 3. You go to the bank and say, "Here's 25,000. I want to invest 100,000 on the Hang Seng Index." But the bank doesn't say that they're going to invest it. You don't care. You're going to get exactly the same amount of money. You're going to lose the same amount of money. But the bank cares. The bank prefers 3 to 2. The bank, this is better for the bank. In all these 1, 2, 3, 4, you will see that every one of these is better for the bank in different ways. Okay, so why is 3 better for the bank? Who can tell me? This is tricky. Okay, this is tricky. Who can tell me why 3 is better for the bank? Because the reason it's better for the bank is that anybody wants to say? Ying, maybe you're going to say that? Maybe you're going to try? I don't know. 3 is better for the bank. In part 2, the bank is committed to taking 75,000 and investing that. Okay. In part 3, they don't have to. They don't have to. They give you. You may say, well, yes, they have to because they're going to be their return. It turns out that we're going to examine these things in detail in the next slide. But it turns out that for the bank, part 3 is not an investment, it's an option they are selling you. This is an option. They're giving you a call option. So for a call option, you mentioned that you saw call options to me. So you probably saw that when you do call options, when you sell call options, you don't have to do a full investment. You just have to invest, you just have to hedge the call options. And typically you do that by investing the delta of the call option. You may have seen this, I hope, okay? I'm going to be mentioning that in the next slide. So this is better for the bank because they have to use less of their money to sell you this product. At this point, this is an investment product that the bank is selling you for 25,000, and it will be an option. We're going to see that in some more detail. Okay, but let me go to the fourth one. The fourth one is really interesting. The fourth one is you want to invest 100 million. You only have 25,000. Okay, so what you do is you go to the bank and say, give me an investment on 100 million. And I'll pay you 25,000. And the bank will say, yes, I will do that with some provisions. This is what's called a CPPI option. I will explain all these things. Okay, I just want you to understand that there's many different ways of borrowing money. So the bank will sell you what's called a CPPI option, which the bank will say, yes, okay, no problem. You give me 25,000 and I'll sell you the option. The bank doesn't have to invest that, but the bank is going to give you provisions, which we'll see in a minute. That, for example, let's say that the investment does well. Then the bank will automatically lend you more money so you can invest even more. Your exposure goes up. Okay, this is good for you. But then at the same time, let's say this will typically come with another provisions where if the investment does badly, the bank will very quickly sell the investment so that they don't lose their 75,000. You lose yours very quickly, but they will not lose their 75,000. Okay, so here you have 4 different ways of structuring a leveraged investment. So a leveraged investment is not as simple as just borrowing money and investing. It's not as simple as going to the bank and said, here's 25,000, what can I do? There's different things that you can do. And I want you to understand these different ways of investing, okay? That's what I am going to do today. And I will end with something very sophisticated, which is an example of a structured credit. I'll show that later. So these are the same 4 options, but expressed with diagrams so that it's easier for me to explain what they are. Okay. So in the first one is what I said. You have 25,000 a million, and the bank is going to lend you 75,000 a million. Doesn't matter. Okay. But let's follow the arrows. Who gives money to whom? The investment is always here. Okay, this investment will always be here. But who gives money to whom? Okay, so in this case, the bank gives you the money and then you invest it. You're in control. You are in control. Okay? Whereas, you see, when you go to part 2, the second investment, you see that you give the bank the money and then the bank invests. The bank is in control. The same return. Okay, so from a market risk perspective, these are the same. And by the way, this is the same too. All these 3 are the same. This is different. This will be different. From a market risk perspective, this will be different. Market risk means the money you make or lose because of the investment, not because someone doesn't pay you. Okay? So do you see that the profile of the market profile of 1 and 2 is different, but the control is different? So the market return is the same, but the control is different. In example 1, you are in control, you invest the money. Okay, this investment of 100,000 or 100 million is in your name. In this one here, it's in the bank's name. That's what's different, and that's why banks prefer this. Okay. Let me now go to part 3. In part 3, you have your 25,000, and the bank doesn't put any money. See, there's no money here. What the bank does is issues a warrant. A warrant is an option, it's a call option, which says, we're going to invest 100 million, you owe me 75, everything you make above 75 is for you, but the first 75 is theirs. That's the way they protect their investment. That's a call option, right? You told me a few weeks ago that you have seen call options. So this thing that we have in part 3 is a call option. So you are investing money with leverage by having a call option with the bank. The bank will give you a call option. So this is better for the bank because you may have seen that when you have a call option, you can hedge it without investing all of the money. You only have to invest the delta of the call option. Okay? A call option, now I'm talking about something that I don't know if you have seen. So this is a call option, a warrant is a call option. The bank hedges it, investing dynamically the delta of the option. And the delta is not 100%. Typically the delta, something like this will be about 80%, 70, 80%. That means that the bank doesn't have, the bank will charge you interest on 75,000 or 75 million. But the bank only has to invest a portion of that, right? So the bank will probably invest 50,000 only. You're 25 and they're 50, they save 25,000. They are charging you interest on 25,000 that they don't use. That's why this is good for the bank. They make more money, right? The bank takes a little bit of risk, but the bank increases their profit. So part 3 or version 3 is better for the bank. Now part 4 is sophisticated. It's called a CPP option. And it's also an option like part 3, but it has there's a difference. The difference in a CPPI option is that you maintain the leverage constant. Again, I have to make a reference to options. In options, you know that the delta of the option changes, right? In a CPPI option, the delta does not change. Let me explain that. I have an example. Let's say in this here, okay, you invest 25,000 and the bank invests 75. Total, 100. Let's say that the performance is very good. You make 50% return. 50% return. So 100 becomes 150. The bank, you still owe 75 and you have 25. But your 25 now controls 150. Here your leverage is 4 times. I'm going to put the leverage in a different color. I'll put it in green. The leverage here in this example is 4 times, meaning the amount of money that is invested is 4 times the amount of money you invest. Your return will be amplified by a factor of 4 times leverage. Okay? 100 is your money times 4. In this case, leverage is 6 times leverage. The amount of money invested is your money times 6. Leverage goes up. And leverage is related to the delta of the option. Okay. So what a CPPI option is an option where the strike price and the notional changes so that the leverage is always the same. Okay. So in this case, the 25,000 is the premium. The delta of the option, so that it doesn't change to 6, what will happen is that the strike price will go up and the notional will go up. That means that you are investing more money. And this is a very good way of, if performance is very good, you make a lot of money. So this here, the risk profile is completely different. Okay, the risk profile is completely different. The market risk profile is very different. Here, the investor makes much more money. The investor makes more money. Also, the investor loses more money more quickly. But for the bank, this is the best because the delta is constant, the leverage is constant, and therefore they don't have to trade in and out. They don't have to hedge that portfolio, which they use to hedge their obligations to you. Okay, so it's very good for the investor, and it's even better for the bank. Okay, so I don't know if this is clear. These are 4 ways of borrowing money which are different for the investor and for the bank. Okay. Is this clear? Is this clear? Okay, so some people say yes, good. So then what I'm going to do is I'm going to explain to you somehow the ultimate in leveraged investing. And it has to do, I'm going to show to you an example of leveraged investing, which is structured credit. I will continue with the same example of 25,000 of yours and 100 total investment. Okay, so 4 times leverage. The difference is here, when you go to the bank and you say, I want to invest 25,000, but I want to have exposure to 100,000 or million. The bank is going to say, this is very good, but instead of them lending you the money or them using their own money for that, what they do is they go and they borrow money from other people. They borrow money from other people by issuing bonds. Very important. We're going to do this by issuing bonds. Okay. By the way, this has a name. It's called a collateralized fund obligation. I will explain why the name and I will explain how it works. So this is how it happens. And the proportions that I have are not exactly now 25% and 75%. They're slightly different because I'm going to make a connection between this example as something that actually happened in reality, where the proportions were a little bit different. Okay, so it's still very similar. It's still, in my example, is almost 25%, not exactly, it's 27. Okay, but you will see what I'm going to do. This is the interesting part. Please pay attention. Please pay attention. This is very important. For you, it's very similar to what we were doing earlier. You're going to invest a fraction, say a quarter of the whole thing, and then you're going to collect all of it after you pay interest. It's just that here now you don't pay interest to the bank, you pay interest to the bond holders, you pay interest to the people or institutions who lend the money to the investment by buying a bond. Okay, so for you, it's very similar as before. You're still going to get 4 times the performance. But what is important to understand is how you raise the money, how people invest in this through bonds. And I'll say one thing, the interesting part of the collateralized fund obligations is not much your investment as an equity investor. The real interesting part here is your investment is the investment of the bondholders, because we're creating new bonds, and this is the interesting part. So let's walk through that. How are we going to borrow 75,000? In this case, it's actually not 75; it's only 73. Okay, 73,000. How are we going to do that? Or 73% of the whole thing. How are we going to do the 73%? So we're going to do it as follows. We're going to issue 50% of the money, of the whole thing, of the 100 million or something. We're going to invest 50% of that money by issuing a bond. So there's going to be some investors who come to us and we borrow money from them by issuing a bond, and they get a certain return on that. The return is the yield, and the yield is here. Okay, and the yield, I have a bar graph of what the yield is going to be. I don't care about the actual number of the yield, where I care about the size, the relative size. That's why I did it in colors and in a chart. And you will see that the yield of the blue part is very low. So we're going to give interest to the investors, but interest is not very high. Why is that? Why is that? This is the reason. The reason is that, I don't know if you have seen what the collateral is, debt obligation is. This is similar. The reason is that if we lose money, the collateral of these bonds is the value of the fund. And these bonds that I call blue, they are the senior bonds. They get paid first. So if something happens, the first person to lose money is you, the orange one. The next one to lose money is the yellow one that I haven't mentioned yet. And after that is the green. And after that, at the end, is the blue. So the blue is the safest investment. That's why the yield is the smallest. Okay? When we try to borrow money from the green bonds, the ones which is 13% of my total investment, I tell them, you are next in line after the blue, and you are ahead of the orange and ahead of the yellow. That's why your yield is a little bit bigger than the blue, but it's smaller than the yellow, because the yellow comes after you. So the yellow has more risk of losing if the performance is bad, right? And then finally is the equity. The equity has no collateral. The equity, if you lose, you lose. That's it. But the equity investor has access to all of the upside. That's why these are very attractive investments for it's called the equity investor. Equity meaning that is the unrated part of the structure. So these bonds that you issue here, these are bonds. These bonds have a probability of loss, which is given here. The probability of loss of the blue one is very small because they're the first ones to get paid with the money that is left over. Then the probability of loss of the green is a little bit bigger. It's still smaller than the yellow. The yellow is next. And the probability that you lose money is the biggest of all, because you are the first to lose. Okay. So this is called a structured credit, because when you have this investment structure, this 100 million investment, that 100 million, it has obligations. It has obligations to people who put money there. You put money, you are the equity investors. The bond investors put money. So this 100 million has obligations to those. But the obligations are ranked. Some people have priority, high priority, and some people have low priority. You have very low priority. You have the lowest priority because you are the equity investor. You are the first to lose. The blue one is the last one to lose. That's where the probability of default is the smallest, is right here. You see? It's a way of, and this is something for, of course, you don't do this for 100,000. This is very expensive to set up. The bank is going to charge you a lot of money to set it up, not interest, just to set it up. So this is good for very big investments. I think we're going to show, I think I have an example of one. Yes, that one happened. I'm going to show you an example of something that happened in reality, okay? This is how it works. And maybe another way of understanding the probability of loss, and this may link to some course in finance you may have taken, has to do with the recovery rate. If I look at the recovery rate, let's say that for some reason the investment loses money. Okay? What's the percentage of your investment that you expect to recover? Well, you are the equity investor, you recover nothing. You are the first to lose. But you see, there's a recovery rate for the yellow investor who is right below you, which is some recovery rate. It's small, but they will recover some of their money. Then the green investor recovers more, and the blue is the one that recovers the most. Okay? This is in the event that you lose money in that investment. So this is an interesting combination of you taking a lot of risk and a lot of return, and other bond investors taking different types of risks and different types of yield. For them, the return is fixed, is the yield. Okay? If your performance is fantastic, they only collect your yield and nothing else. They have no upside. They have protection. Okay? Okay. So I want to, this is an important example to understand. And maybe what I want to do is I want to show you something that happened in history, a real number of a real investment. So you can see how this thing works. So this is an example from 2002. It is, as far as I know, is the first CFO that was created. And that was a company called Mann Glenwood. Mann is a very big investment firm based in London. Very big, issued the first ever collateralized fund obligation with 160 million of unrated notes. That's the equity part. That's what you invest. So it wasn't 25,000. It's 176 million and 374 million in bonds. Okay. So let's see, altogether, if you add this up, that's zero. I actually don't know what. 15, 5. So it's $550 million altogether, I think, if I did the calculation right. Okay, it's $550 million altogether, of which 166 million was the equity part. Okay. Now let's look at and then there's these bond issues. These are the bond tranches. 3 bond tranches. So let's look at this. 125 million of the 374 had obtained a rating of AAA. AAA is a very good rating, meaning that this is very unlikely to default. It's very likely that you will collect all of your money and what is owed to you. The yield on this bond was 60 basis points. 60 basis points, I think you know, is 0.6%. Okay? Plus LIBOR. LIBOR is the interest rate, which is the risk-free interest rate. Okay? So this is a good return for a AAA rated bond. AAA rated bonds, they typically have a return which is less than LIBOR. Okay, so this is LIBOR plus 60 basis points. This is good, meaning it's attractive to the bond investors. This is a good return. The next one is rated A and is LIBOR plus 160 basis points. That's 1.6%, also very good. Okay, if you're a bond investor, these are good returns for your bonds given this rating. The next one is rated BBB and has LIBOR plus 250 basis points, much higher. See, why is the return higher? Why is the yield higher on these bonds? Because the probability of loss is higher. That's how it goes. Okay? And then the last one is unrated note. Is 66 million. Now, so again, I'm showing you a real case. So what I'm showing you here is actually something that happened. It's real. So with such a bond came some risk conditions. The investment that was going to be done with these $500 million could not be anything. It had certain conditions. These are the conditions. So you have an idea. Okay. The conditions were many more. This is just a summary of the conditions. Okay. So 20% of the funds had to be in separately managed accounts. I mentioned very briefly what a managed account is, very briefly. It's not something very important for this course, but it's something which is there for risk mitigation, okay? Then the investment had to be done into 25 different funds. It was a fund of funds, as we saw last week. And it had to have at least 25 different funds. Not 24, at least 25, 26, 30, 50, okay? Of at least 4 different strategies. They could not all be equities, or they could not all be futures or macro. They'll have to have 4 strategies, 25 different funds. Why is that? That's for diversification reasons. Diversification lowers the risks. That's why these are risk conditions. You see, everything we have seen now comes together when you look at the real case. We have seen different trading strategies. Well, when they created this investment, they demanded that the strategies had to be diversified. And they did it like that. Okay? Look at this one. Allocated by volatility and market exposure. Let's forget about market exposure. Allocation by volatility. What does that mean? That's risk parity. Right? So you're going to allocate less to more volatile assets and more to less volatile assets, just like in your assignment. Okay? And immediate liquidation when the equity loses value. So that means that if for whatever reason your 25,000 is lost, they sell everything immediately because they don't want to lose any of their money. It's okay if you lose your money. They don't want to lose their money. That's why they demand immediate liquidation. Okay? Now this, if you look at these risk conditions, they're very interesting. Because these risk conditions here, they summarize everything we have seen in this course up until now. Okay, so let me use this as an example too. Many of the things we have discussed here, they're explicitly showing up in the risk conditions of this particular investment, $500 million. And I want you to feel good about this because this is something that you understand, you know. You've done all of this yourselves. And in the assignments and everything, you're in a very good position to understand this instrument, which is extremely sophisticated. You're in a very good position to understand it, much better than 99.9% of the investment professionals in the world. Okay, so if today I can say that we have climbed a very big mountain together, we've learned lots of things together, this should be proof of that. This is a very sophisticated investment, and today you understand, I think, absolutely everything which is here on this page. And I'm telling you, many people don't. Okay? They understand in the risk conditions how you allocate by volatility, your market exposure, the implication of the funds, the different strategies, and all of that. We have seen it all in this course. Everything comes together in this particular example. That's one of the reasons why I like it. Okay, I want to take a pause because I want you to be aware of what we have learned so far. All of this is now visible if you look at the example which is in front of your eyes. Okay. We just need to be able to do assignment number 8 and then we're all the way there. Okay, so let me, I have 6 minutes left. This is what I want to do in the 6 minutes, okay? I think this is well understood. Well, I think so. I think so. The technical aspects of assignment number 8 is something that you have to struggle with, and I'll help you with that. But I think this is understood. What I want to do now, I want to mention something. I'm going beyond. This is now much more sophisticated, but I want to say something interesting, and that's a connection with history. So everything that we see here is fine, and this is the year 2002. Okay, the year 2002. Now, do you know what happened in the year 2008? Yes, you do. That was the year of the big crisis. Okay, that was the year of the big crisis. the big financial crisis. How did the big financial crisis develop? What happened there? It's complicated. It was the subprime. I don't know how much of that you know. But today, there's one aspect of the 2008 crisis which becomes very relevant for us and very relevant in the context of the CFOs that we have done here. And I'm going to show you this chart. This is, I'm very proud of this because I did this chart in 2006, 2 years before the crisis. Okay? And what is this? Well, this is the following. What I have here is the probability of default of the bonds in a CFO. Okay? The probability of default of bonds in the CFO follows, these are the different tranches, senior tranche, the junior, different ones, and there's the equity. Okay? And this is how the probability of default changes when the correlation between the different funds goes up. As the correlation of the funds goes up, the probability of default goes up. Okay, this is, look at this, it's here, right? It says 25 funds in 4 different strategies, but it doesn't talk about what the correlation is. You know that the fact that there are 25 different funds and 4 different strategies is because they are aiming to low correlation. If the correlation is low, this is good, but if the correlation is high, this means nothing. So when you go to this example here, what you see, this is a graph that I did, one of my publications, one of my papers. What you see here, and I just want you to understand it. I don't need you to know how this is done, just to understand the concept, because the concept you can understand. As the volatility, as the correlation increases, the probability of default of your bonds increases too. So these CFOs become risky if the correlation numbers go up. Okay? And at the same time, they become less risky if the correlation numbers go down. So, I mean, you already knew that. Here you have a graph that actually quantifies that. This paper is very, I mean, you can read it. It's on my website. I don't recommend that you read it. It's very complicated. But I want to make a final connection with assignment number 8. Okay, in assignment number 8, what are you doing? You are calculating the allocation with zero correlation and with a real correlation. And this actually matters. Correlation sensitivities are very important. Okay, because I could ask you. There would be a third part here, which I am not going to do. It's very silly, but I want you to think about it, which is what would happen if you do this assignment assuming that the correlation is exactly equal to 1 to all of the funds? What do you do? When correlation is 0, some funds are riskier, they get some number other. Okay, but if the correlation is 1, what happens? What do you do? This is the crisis consideration. This is what is called a crisis scenario. In a crisis situation, the correlations go to 1. So there could be a question here, which is what happens if correlation goes to 1? And then this assignment becomes very interesting because here you have this is easy. It's there because it's easy, mathematically easy, computationally easy. This thing is here because it's real. Okay, and this thing is here, this thing would be here because it's a crisis consideration. So if you think that a crisis might be coming, you must say, wait a minute, maybe these correlation numbers that we calculated are not correct. Maybe correlation should be 1. Maybe that's how I would put my portfolio together. Okay, so that would be a defensive construction. Okay? And then suddenly, this assignment number 8 takes a whole new existence, which is sometimes you want to make decisions just because something bad could happen. This is a way to preempt risks happening in the future. And that affects the portfolio construction mechanisms. As you can see in the notes, the next chapter that comes is risk management. We're going to discuss these things later when we talk about risk management. Okay? But, well, it's time to end, but it's time to reflect. And I want you to be aware that what we have, I'm going to stop here. I want you to be aware that I don't know how many weeks we have now, nine weeks or something. We're approaching the end of the course, but the stuff that you have learned are now put you in a very good position to understand many of the things which are actually done in the financial sector for investment products of millions and millions of dollars. Okay, you're in a very good position to understand that. So from now on, you will see that everything that I have to explain will be much easier for you to understand, because a lot of the difficult things we've already learned. Now we're going to have a parade by understanding different things, which will be easier because all the difficult things you have learned, we've put them behind you. Okay. Okay. So, any questions? My time is up. No. So I wish you well. Okay, with your the confinement and all of that. Stay healthy and mentally healthy and everything. Okay, and I will work on some explanation of what you need to do this difficult part of assignment number 8, which I guess will become assignment number 9. And from now on, we will just be, everything we'll do will be more practical. We're going to focus more on the assignments, the things that you do, so that you can solidify everything that you have learned so far, which is a lot. Okay? Very good. So have a good night, feel well, and I will see you in a week.